Hello, everyone, and welcome to the NASDAQ Dorsey Wright podcast for the week ending on April 21st. We have a very special podcast this week. My name is Ian Saunders, and we're joined as well here by Nancy Davis of Quadratic Capital. So very special podcast this week for that reason, for another reason as well, where actually this is going to be our 900th podcast episode that has been available there on Apple Podcasts. So started back in 2009. Nancy, thank you for joining here, and thank you for helping us ring in number 900, I guess.
Thanks for having me. Great to be here.
Wonderful. And so just a little bit of a background for Nancy. Nancy, I'll kind of just give a brief background for you and then kind of let you tell a little bit of your own story there. But as I mentioned, Nancy Davis is with Quadratic Capital, founder and portfolio manager of Quadratic Capital. Prior to that, she spent, I think, almost 10 years, I think we were talking, with Goldman Sachs, ultimately leading there as the head of credit derivatives and OTC trading. And then you left, Nancy, to start Quadratic Capital back in 2013. So we're talking it's 10 years. I mean, the past 2 to 3 years seem like they've flown by, but certainly just 10 years, hard to believe 2013 was 10 years ago now.
Yeah, no, it's wild. It's blink of an eye.
So thank you for coming in here. And maybe if we just want to start off by talking a little bit, let you kind of introduce yourself and why you left to start Quadratic Capital and kind of what the story is there.
Yeah, well, Quadratic is a pretty diversified strategy. I think that's one thing in the asset management industry. There are a lot of different firms out there, but they all kind of do, I'd say, similar things. And I've always been kind of an out of the box thinker and trying to solve problems for investors. And so giving investors treasury funds that don't take credit spread risk is really important to me. We do all positive convexity here. So long optionality. So it's kind of opposite of a mortgage. And that's sort of what we do here and giving access to this differentiated asset class.
That's great. So I know there's 2 funds that you have with Quadratic there, which we'll certainly get into more here in just a bit. But what maybe from a broader kind of taking a step back for more of a macroeconomic perspective, what kind of things are you all looking at Quadratic? I know you just kind of mentioned the convexity there, so using kind of options within the funds. But I mean, there's been a lot of economic news over the past week, over the past couple of weeks, certainly over the past year, a lot of things happening that A, we haven't seen before, or B, haven't seen in quite a while. So what kind of things are you all looking at on a day-to-day or week-to-week basis there?
Well, there's a lot going on right now. It's been, just for perspective, being April 20th, it's been barely over a year since the Fed started hiking rates. We've had 475 basis points of rate hikes over this period. We have another 25 basis points priced in for the next May meeting. Think about that. That's pretty amazing on its own. We've had a banking crisis with Silicon Valley blowing up. We're probably running into a debt ceiling crisis pretty soon coming into the summer. I think that'll be more topical. And rate volatility is something that most regular, 60-40 investors are only short in their portfolio. So that's part of our message, is to really educate investors that, very simply, mortgages are always the problem. We just put out our investor note. We'd be happy to send it to anyone who's listening to this podcast if you're a financial professional. But all mortgages are kind of the crux of all these recent financial crises, whether it was 2008 or all these negative convexity funds and things like the AGG index. A third of the AGG is mortgages. And very simply, U.S. homeowners are along the option to prepay. Therefore, owners of financial mortgages are short options to homeowners. And whenever you're short options, you're short vol. It's not equity vol, it's fixed income vol. So that's it's definitely very timely. It's really important for people to understand that. And that's part of our education message.
Absolutely. And I think that brings up a good point kind of you touched on there, just there at the end, looking at kind of the equity vol versus fixed income vol. I will say a lot of those that might be more familiar with Dorsey Wright, we focus a lot on the equity side of things, right? Looking at different kind of volatility metrics. We have a study that looks at like the daily the number of 1% moves in the S&P 500. Obviously, the VIX being the more popular kind of vol metric. But I know you've talked about there and talked about a lot, looking at more interest rate volatility or volatility within the broader rate perspective within fixed incomes. Do you think that's something that many investors know about, or I mean, how should they kind of be focusing in that regard?
It's harder to see it. I think that's the problem, is that a lot of the index world grew up on the equity side of the business. So you have to have a listed security, whether it's a listed future or a listed, security, to see prices. So it's really easy to see the VIX because it's an index. So it's something everybody can pull up. It's pretty hard to see the swaps market data, even just the level of swaps. It's not treasuries, it's the unfunded market. So, obviously there's the treasury market and the rate side, but then there's also the swaps market, which is tremendous and much bigger. That's the unfunded market. So when you have, every corporate issuer around the world, every sovereign around the world, when they sell bonds in US dollars, they turn around and hedge their rate risk in swaps. So the swaps market is a huge market, and just even basic swap pricing is really hard for regular people to see, let alone swaption volatility, which is options on swaps. So we're trying to help folks be aware of what they can't necessarily see.
So I like the swaptions. Is that hadn't heard that? Is that something that you coined there? Is that
No, it's a real thing. It's basically an option on a swap is a swaption.
Wonderful. You have to forgive my naivety there.
No, it's all good. It's definitely a little bit of a niche market, but I think that's so important for people to understand that anytime there's an options market, there's a vol market, because volatility goes into pricing options. So you can't have, it's sort of like, do you use a Kleenex or do you use a tissue? It's the same thing. It's options mean vol. So in order to have a vol market, you have to have an options market. In order to have an options market, you have to have a vol market.
And so for the kind of measurements of kind of volatility, it is something like the move index, something that you all are kind of tracking and more up to date with. We touch on that a little bit and kind of the movement in our written research, but more so just its swings that it's seen over the course of the past year. Is that something that you all are looking at as well?
It's not what I'm talking about. It is unindexed, and it's the only thing, Ian, to your point, it's the only thing out there that's an index, but it's treasury options. So it's listed options on treasuries that trade in future format. That's not where the big money is. It's actually in the swaps market. So again, going back to the whole index problem, indexes, you need a price, you need something that's consumable. So move is short dated bond volatility, which is on treasuries. What I'm talking about is the bigger market, which is the swaps market. So that's, to buy a treasury, you have to put up cash, right? Whereas swaps, which is kind of, the UK pension fund blow up was recently about their swaps, right? They were receiving rates in the swaps market, which is leverage, right? And that's kind of the two things that always blow up markets. It's short volatility and leverage. So
it certainly is a lot of different aspects to be looking at there. Maybe kind of taking a look at some different things that financial advisors might be able to kind of focus on or monitor within this space. I guess a lot of what you're doing on the ETF side, you're kind of tracking it and making decisions there within the fund. So advisors or investors might not necessarily have to, right?
Well, I think the thing we try to educate investors is the AGG index. It's an old index. It used to be the Lehman AGG, and then it was Barclays AGG. Now it's called the Bloomberg AGG. But pretty much every manager is benchmarked to the AGG. The AGG has two problems. Number one, it's only short volatility because a third of the AGG is mortgages. So it's only short vol because mortgages are homeowners owning the option to prepay. Owners of the financial mortgage are short options to homeowners, therefore short fixed income vol. So most people only have short vol on their bond portfolio, which is not great in my opinion. And number two, the AGG has no inflation protection in it, which is kind of wild when you take a step back, given inflation has been such a big focus since the pandemic, and the Fed hiking rates, 475 basis points with another 25, 5% priced in. There's no inflation protected bonds. And that's probably because inflation protected bonds are a pretty new market. The US Treasury only started the inflation protected Treasury market. They're called TIPS, Treasury Inflation Protected Securities, in 1997. And there are no TIPS in the AGG index. And I think a lot of investors are looking at right now what happened in the 70s and 80s and what can they do to protect or potentially help investors with inflation. And I want to grab people and say, you can't look at the 70s and 80s only because some of these major markets, like the inflation protected bond market, didn't start till the late 90s. And the swaps market data, the farthest you can go back data is to the late 80s. So looking at just the 70s and what happened in the early 80s is kind of, using a really narrow lens to look at inflation. It's mostly looking at, people look at commodities, people look at oil, gold, cyclical equities, real estate. And I call that your grandmother's inflation because why not look at the inflation markets? It's sort of an obvious thing, and the interest rate derivative markets, but most people just don't have access to look at that data and it doesn't have a back test.
And so how does kind of the ability to look at some of that data and some of the kind of factoring into the kind of decisions you're making on the portfolio management side? Obviously the being able to take advantage of that in something like an ETF wrapper through options. The kind of growth in using options in ETF wrappers. It seemed like it's exploded over the past couple of years. And obviously you all were some of the kind of earlier ones to do it kind of 10 years ago. How does that kind of relate? Why do you think of the ETF wrapper as a good way to kind of leverage that perspective and expertise?
Yeah, well, thanks, Ian. We were, as far as I'm aware, the first ETF to use OTC options inside of an ETF. I just thought the ETF wrapper was an amazing technology from a tax point of view and also from an access point of view, because we do access the rates market, which is not, it's not a listed security, it's an older market. And so to give access to a commingled fund that accesses this historically institutional market is really exceptional. Like most institutional investors, like say a real estate investor, they hedge their rate risk in the OTC markets, but regular people don't have access to that. So we just thought it was a really great thing to QSIP it, kind of like the mortgage market, 40 years ago got QSIPed. We're QSIPing it, but instead of only being short vol, both of our funds are long fixed income volatility.
Okay. And so in looking at, those funds, I see, the tickers are certainly pretty kind of indicative of what you're looking at for the broader funds, right? eyeball rolls up off the tongue very easily there, but
well, it's not eyeball. Whenever I say it, I always think it sounds like eyeball, but it's like inflation or interest rate ball. But
right, IVOL for those listening and following along. But the quadratic interest rate volatility and inflation hedge, right? Kind of interest rate volatility, eyeball. That was the first fund that you launched, right?
Yeah, it's about almost 4 years old now.
Okay, and so with that one is maybe just kind of explaining the difference between that and the other one is the BND, which is BNDD, which is more on the deflationary side, right?
Yeah, so IVOL is really a solution to the inflation protected treasuries on their own. I had just started my career in the late 90s at Goldman, right when the U.S. Treasury invented the TIPS market. And I remember thinking as a young trader, I was like, this is not going to work. Like, it's in name only because they're bonds. So all TIPS, whether it's a short duration TIP or a long duration TIP, they're all bonds and they all have duration risk. So even short duration, that's one of my pet peeves in the industry, is short duration is like a fake name because it's not short anything. It's just less long. It really should be called less long duration because it's still long duration. So what we do in IVOL is we try to solve the duration problem with TIPS by having a strategy with options to benefit from higher 10-year yields. So that's when the bonds will lose money as interest rates go higher. bonds lose in price. So we have a way to benefit when 10-year yields go higher, but also TIPS are only accessing the CPI, right? So CPI is just an index. It's the consumer price index, and it's the index that even the Fed is not, relying on these days. And so it seems kind of narrow, like nobody in the equity world would ever use, the Dow Jones index or the Russell or the NASDAQ or the S&P to capture the US equity market. It seems very narrow in our mind to use one index to capture inflation, especially because CPI, a third of it is what they call shelter, which is measured as rent. It's owner-occupied rent. So we just don't think such a big component being rent is the only way to measure inflation and giving investors a measure of inflation outside of CPI. So we take both of our funds are mostly treasuries. So about 80% are treasury funds. And then we add fully funded interest rate options to both of them.
Okay, and you'll see that. I mean, if you look, just looking up like the holdings that we pull in on our research platform, and you'll see like 80% in treasuries, right? And then the derivative products is talking about, right? And so so eyeball was the first one, and then BNDD, the quadratic deflation ETF, right? That came out. That was a more recently launched fund. Is that right?
Yeah, exactly.
And so seemingly kind of contradictory the approach is there. What's the kind of reasoning behind the two different areas? Just kind of giving investors the option, no pun intended, whichever one that they feel might be most appropriate at that given time, or is it how do you kind of see that working out from a broader investor allocation perspective?
Yeah, so IVOL would be more of a replacement for TIPS alone. So it's a TIPS fund plus another measure of inflation outside of CPI. So that's specifically like you can have treasuries and TIPS inside your portfolio. They're not contradictory to one another. BNDD is a treasury fund. So it's a long duration treasury fund, but instead of using linear leverage to capture, that's what most people do using futures or all linear derivatives, meaning they go up $1, down $1. Same with swaps, up $1, down $1. So you could make $1, but you can also lose $1 just as easily. So we use options to give convexity to that fund. Benefits from lower 30-year yields or higher 2-year yields. So it's either the Fed hiking and creating a recession or slowing growth, or people buying bonds. And so both funds are, you can use both. It's a replacement for treasuries alone is BNDD, and IVOL is a replacement for TIPS alone.
Got it. Okay. And so, in looking at some of the recent price movement of those, as we were talking about, us being more in the specifically focused on the price movement side of things, I do think it's kind of interesting. We've seen a little bit more outperformance from the deflationary BNDD over the course of a year-to-date basis. Both had a pretty solid March there. I didn't know if there's anything kind of speaking to that perspective, kind of the similarities and differences we've seen just over the past year between those with all the broader movement going on in the market.
Yeah, BNDD is definitely benefiting from, and Powell said it not at his last Q&A, but the prior one, he said disinflation, I think 15 times. Disinflation is priced into the rates market. So everyone is expecting inflation to fall dramatically in the future, and that disinflation has actually been benefiting the deflation fund. Whereas the inflation fund, TIPS were down 12% last year, which I know is really challenging for people to understand because CPI was over 6 all year, but inflation expectations in the future fell. So, we actually just put out a institutional investor letter kind of explaining the TIPS market, because even though TIPS are treasuries, I don't think a lot of people necessarily are in the weeds about how they work. So if anyone would like a copy of our letter, just, shoot us the email and we'd be happy to send it to, it's for financial professionals only, so not retail, but happy to try to demystify these markets, because it is a weird thing when you feel so much inflation in your day-to-day lives, but all markets are forward looking, just like equities, right? Equities are not moving on what happened today or what happened in the past. They're moving off of what do you expect in the future? What is the multiple? What is the earnings in the future? Rates and inflation are the same thing, right? So all markets move off of expectations in the future, and expectations in the future are that inflation is going to dramatically fall. Markets are really pricing in a very disinflationary environment. So it's very interesting because if you look at the five-year break even, it's 2.2 right now. If you look at the forward inflation expectations, it's all around 2%, a little over 2%, but substantially lower than the last CPI print, which was 5%.
Right, and those, the inflationary prints have been kind of coming down on a month-to-month basis, right?
Yeah, and they're priced to come down. That's the thing, is it's all about what is priced into the markets, what's expected. And so this letter kind of explains, like, this is where your break even is. And again, it's only CPI inflation, and the yield curve is massively negative. I think that's one thing that people really need to pay attention to. There are a lot of different types of yield curves. You can have, there's a treasury curve, but what we focus on is the swaps yield curve. So that's the swaps market, which is arguably a much bigger market because it's more global and unfunded around the world, and that is massively negative. So it's a really interesting time because the market is basically really expecting a lower growth environment.
Right. It'll certainly be interesting to see how that continues to play out. I know we have a Fed meeting coming up in a couple of weeks, so I don't mean to kind of put you on the spot, but how do you think that all this might continue to influence or the decision-making process there? I believe the markets are still kind of pricing another 25 basis point increase the last I saw. It seems like on a week-to-week basis, each of the market pricing in certainly seems to be shifting, but what do you think might be playing out here in the near future?
Yeah, no, we have 27 basis points priced in today in the Fed fund futures. So the market is expecting the Fed to hike. I think the surprise would be actually as we go into the summer months with the debt ceiling being more of an issue where, think about all the flow of funds, right? Silicon Valley blew up because of mortgages. That's a really important thing for people to understand is they had a lot of mortgages. Homeowners didn't prepay as much because they're rational. So when rates go higher, they prepay less and the mortgages extend their duration, right? And then they had a bank run and had to sell their assets when they were down, which is, it's always the same problem. It's just like different players in the market. And so then you had all this money flow out of the banking system into money market funds. But what do money market funds buy? They buy, all sorts of short-dated government products, including T-bills and other things. And now we have the debt ceiling, which is creeping up upon us. And you can see the T-bill market has a little kink, even pricing in this 25 basis point hike in May. The market is expecting kind of a turbulent time. But definitely not. I think we could see a real huge flow of funds back out of money market funds if we have money market funds that are not getting paid off their T-bills by the US Treasury. And then we're going to be talking about breaking the buck and all of that chaos circle back to 2008 again. So it's definitely a really, I think, important time to not only be short fixed income volatility. And that's kind of our big message, whether you think it's going to be inflation, deflation, you don't know. If you have the AGG index or managers that are benchmarked to the AGG, a third of that bond fund is short volatility because that's what a mortgage is. You're short options to homeowners. And so we just think it's really important time for investors to be aware of that because maybe it's not the best time to only be short vol, right?
Right. And so, I know you've done a lot of, thank you for kind of helping us become more aware of it, and certainly all the listeners as well. You mentioned a few times the recent report that you all did for more of the institutional financial professionals only. How can people reach out to you, or where can they learn more information about the two funds as well as the broader Quadratic Capital Group?
So they can go to the KFA website, so the Crane Fund Advisors website. There's information there. Each of the ETFs also have their own website, so you can go to ivoletf.com for ivol information, or bnddetf.com for bndd information, and then there's a contact us page. So you'd be happy to send us an email. The letter is not on the internet, but we can definitely send it to you and get it out there. But there is a lot of educational information out there, whether it's articles or videos or fact sheets and prospectus, obviously. So it's all out there. The nice thing about ETFs is they are public funds, so it's very transparent about what's actually in the strategy and what they do, because we follow a prospectus.
Perfect. And so that's kfafunds.com, right?
Yeah, so KFA is Crane Fund Advisors. That's our advisor for both of our ETFs. Or you can go to the fund's websites directly, which is ivoletf.com and bnddetf.com.
Perfect. That's easy enough.
Yeah. Keep it simple.
Exactly. Well, wonderful. Well, Nancy, thank you very much for jumping on the podcast with us here this week, and for helping us to kind of shed some light and learn a lot about the broader swaption market and different ways that investors can kind of access that for hedging tools. If anyone else has any kind of questions about any of those, you can, feel free to reach out to us as well on more of the technical side. Happy to kind of connect you and move forward from there too. But Nancy, thank you for joining us this week, and to all our listeners, thank you for tuning in this week as well. And we'll be back to talk with you next week.
Thank you. Thanks for having me on for Magic 900 episode. It's awesome.